The 2024 lifetime capital gains exemption is now over $1 million. And to be exact, it is $1,016,836. But you don't automatically qualify for this exemption. There are very specific rules the CRA outlines, and as a business owner, you need to make sure that you are eligible and qualify for all of the rules, or else you are going to be unable to use this, and it's going to be very costly. So for starters, you need to ensure that you have qualified small business corporation shares, QSBC, which basically means they are Canadian controlled private corporation, and it is a corporation that is a resident in Canada whose shares are not traded on a public stock exchange and which is not controlled by non-residents or a public company. So that's kind of starting point number one. Number two, you need to ensure it is a share sale, not an asset sale. So a lot of business owners end up doing an asset sale, and that would make you basically ineligible to use this lifetime capital gains exemption. The sale of your company has to be a share sale. There is also what's called a 24-month holding test. And what this means is the seller or a person related to the seller must be the only person to have held the shares in the 24 months leading up to the sale. So basically what that means is you can't issue new shares or buy new shares today and try and use the lifetime capital gains exemption tomorrow. There has to be a 2-year ownership period where you own the shares, and then you're eligible to use the exemption. Another test is the 50% test. And what this means is in the 24 months prior to sale, more than 50% of the fair market value of the assets of the business must be used principally in the active business of the corporation carried on primarily in Canada. So what this means is basically at least half of the assets in the corporation for 24 months prior to the sale has to be considered active business assets. It can't be passive income. So you can't have stock portfolios or perhaps rental properties or basically assets that have nothing to do with the business. Certainly can't be more than 50% of your total assets. And then very importantly, there's also a 90% test. So the 90% test means at the time of sale, all or substantially all of the value of the corporation's assets must be used principally in the corporation's active business carried on primarily in Canada. So what this means is at the point of sale, 90% of the assets in the corporation have to be considered active assets, active for the corporation. They cannot be passive. So the CRA generally interprets substantially all as meaning 90% or more of the value of the corporation's assets. So that's where you get the 90% test from. So basically, if you have passive assets in the corporation, they could throw you off. So you need to look at ways of purifying your operating company, perhaps using a holding company to transfer assets into the holdco, which is something you'll own for the rest of your life, but you can still sell the opco and the shares of the opco as well. Now, I'm going to give you an example here. So let's say you sell shares of a small business corporation, which is eligible for the lifetime capital gains exemption for $1.5 million. So someone basically offers you $1.5 million for your business. Without the lifetime capital gains exemption, you would have to pay taxes on half of this amount. So you're paying tax on $750,000. With the LCGE, you can subtract the $1,016,836 from the sale and essentially only pay tax on, you do 1.5 minus the LCGE times 50%, you're only paying tax on $241,582, not that $750,000. So this is, it's very costly to not qualify for it, and it's very beneficial when you do qualify for it. So you want to make sure, again, you hit all of these qualifications. And I get the question quite often, can you multiply the LCG? In other words, can other family members or partners, et cetera, use the LCG? And the answer is yes. With strategic planning, you can utilize other family members' LCGs to help mitigate taxes on the sale of your Canadian-controlled private corporation. So you can implement, for example, a trust, and you can have multiple beneficiaries of the trust, and you can, in turn, use their LCGEs to offset the sale of the business. So if you had, say, 5 family members and each had about $1 million, you could, in theory, qualify to offset over $5 million of a sale of your corporation if you're using every single family member's LCGE, and obviously they haven't used it in the past before, so they have the full amount eligible. So anyways, lifetime capital gains exemption, extremely important to understand what it is, how you qualify, and very costly if you make a mistake and throw yourself offside.